Welcome back. To wrap up this topic on discounted dividend valuation, let's learn how to determine the implied required return of a stock based on its market price and sustainable growth rate of earnings. Let's get rolling. Recall in an earlier lesson, we mentioned that the Gordon growth model has 4 variables and that given any 3, we can solve for the unknown variable. We demonstrated the calculation of the implied growth rate based on the current stock price, current dividend, and an assumed required return of the stock. The implied growth rate is the rate that investors expect when they purchase a stock at its market price. Another application of the Gordon growth model is to calculate the internal rate of return of the stock based on the market price and an assumed fixed growth rate. If you subscribe to efficient market hypothesis, then this IRR is an estimate of the required return of the stock. Calculating this IRR is very simple using the Gordon growth model. Simply plug in the current dividend, stock price, and assumed growth rate, and solve for R. To illustrate, let's return to the XYZ example that we've worked on in the lesson on Gordon growth model. Based on the analyst's assumptions, the intrinsic value of XY stock is $104. We've also calculated that based on the stock price of $130 and the assumption that the required return is 9%, the implied growth rate is 5%. This time around, let's make the assumption that the growth rate is 4% and use that to calculate the implied required return. Pause the video now and work out your answer. And we're back. This should be pretty simple for you. Plug the figures into the Gordon growth formula, rearrange, and the implied required return of XYZ stock is 8%. This approach of calculating the implied required return can be extended to other types of dividend discount models that we've learnt. The calculation for the H model is very straightforward too. Let's see if you can solve this. Chennai Corp recently paid a dividend of $3, which has historically been growing at a rate of 8%. The growth rate is expected to progressively slow to 5% over the next 4 years, and then remain at 5% indefinitely. If the current price of its stock is $60, calculate the implied required return of the stock. Pause the video now and work out your answer. And we're back. Let's first recall the H model equation. Plug in the figures and rearrange. We get a required return of 10.55%. That was rather straightforward, wasn't it? However, for some other types of multi-stage dividend discount models, the solving of R may not be that straightforward. We shall illustrate with another example. Monstrous Tech recently paid a dividend of $1. The company is expected to grow at 15% for the next 2 years due to an exclusive technology that it acquired, but the growth rate is expected to drop to a perpetual 6% rate thereafter. What is the implied required return of the stock if its current price is $62.30? For this question, we cannot use the H model, as the growth is expected at a constant 15% for the next 2 years. Rather, a general 2-stage DDM where the short-term growth rate is 15% and the long-term growth rate is 6% is appropriate. Before we disclose the answer, why don't you attempt to see if you can solve for R? If you've attempted, you've hit a wall, haven't you? We equate the price of $62.30 with the sum of the present value of dividends plus the terminal value, discounted by the required return. This is very difficult to solve for R. Thankfully, during the exam, you'll be given 3 choices. The trick is to plug in the choices into the equation and see which one fits. We shall illustrate by testing with the middle value first. One shortcut to make quick calculations is to use the cash flow feature on your calculator. For this example, the first cash flow is the first dividend of $1.15, and the second cash flow is the second dividend of $1.32, plus the terminal value. If R is 10%, the terminal value using the Gordon growth model is $35.05. Calculate the NPV based on 10% discount rate, you get $31.10, which is nowhere close to the current price of $62.30. So B is not the correct answer. However, since this value is in between the other 2 choices, you can actually determine which is the correct answer without having to test either of them. Based on 10% discount rate, the NPV is too low. So this implies that you need a lower discount rate to have a higher NPV. Therefore, 8% is the correct answer. Now, let's verify if this is correct. If R is 8%, the terminal value using the Gordon growth model is $70.09. Using back our cash flow calculator with 8% discount rate, we have $62.29. This satisfies the equation, so the implied required return of the stock is 8%. And lastly, let's move on to growth rate. We've talked so much about growth rate for dividend discount models, but how do we estimate a reasonable growth rate for a company? One simple way is to calculate the firm's sustainable growth rate, which is a simple function of the earnings retention ratio and the return on equity. It's not hard to understand this. The retention ratio is the proportion of earnings that the company retains to grow the company. So if we multiply that by the ROE, this gives us the rate at which earnings can continue to grow indefinitely. This fulfills the definition of growth rate under the Gordon growth model. The implicit assumption is that the firm's debt-to-equity ratio remains unchanged and that the firm does not issue new equity. Now, if you recall from level 1, the ROE of a company, which is the net income over equity, can be decomposed into 3 components based on the DuPont system: the profit margin, asset turnover, and financial leverage. This means that the sustainable growth rate of a company is a factor of these 3 components and the retention ratio. This is also called the Pratt model, based on the first alphabet of each of the 4 components. 2 of these factors are functions of the firm's financing decisions, and the other 2 are functions of performance. The product of the 2 factors is actually the return on assets of the firm. Now, if you noticed, the intermediate terms all cancel out, so the sustainable growth rate can also be expressed in terms of net income, dividend, and owner's equity. This expression, however, is not common. But if you're given these values in the exam, you can use them to quickly calculate the sustainable growth rate. In essence, remember all 3 of these expressions for the sustainable growth rate, so depending on what the parameters are that you're given in the exam, you can quickly make the calculation. The Pratt model is also often used by analysts to determine the drivers of growth for a company. Let's see how this works. Companies A and B are competitors in the same industry, and investors like to compare them because historically they have comparable growth rates. Given selected information from their latest financial statements, perform a Pratt analysis and comment on their key drivers of growth. Pause the video now and work out your answer. And we're back. Let's first calculate the profit margin, asset turnover, retention ratio, and financial leverage of the 2 companies. If we multiply all these ratios, their sustainable growth rates are quite close at 3.8%. However, it seems that Company A's growth is comparatively driven more by financing factors. Its retention and leverage ratios are much higher than Company B. Company B's growth, on the other hand, is driven more by its performance. Its return on assets is 5% compared to 0.8% for Company A. And that completes this topic on discounted dividend valuation. This topic is relatively simple and has a lot of testable materials, so do make sure you know the concepts well and get ready to score in the exam. Take a break, and we'll see you at the next topic.